So you've probably noticed something unsettling lately. And no, I'm not talking about the price of coffee going up again, although that is a tragedy on its own. I'm talking about something that could potentially change the entire game of all of us dreaming of home ownership, or making it big in real estate investing. And that is rising interest rates. Now, I know what you're thinking. Come on, Matt, it can't be that bad. Well, buckle up, because today we're diving deep into the end of easy money. I'm gonna break down exactly what's happening, how it affects you, whether you're looking to buy, sell, or just enjoy the home you already have, and what strategies you can start using to navigate this new crazy world. And before we get into it, do me a giant favor and absolutely obliterate that like button if you've ever dreamed of owning your own home or just saving money. Because let's be real, saving money is always a great thing. Now, with that being said, let's get into it. So before we get too deep into it, why do we even have high interest rates? Why is the central bank even in control of them? And what does it all mean? Well, the central bank is totally independent from the federal government, like the president or the prime minister, depending on the country, which we all know is bullcrap. They are not independent, but they're supposed to look like they're independent and make decisions that are the best for the people. And their sole job at the central bank is controlling inflation. See, inflation is crucial to a good economy. Too much inflation and living in the economy is too hard. People can't make ends meet. And too little inflation means the hamster wheel isn't turning. The economy isn't progressing. Wages aren't increasing. The American dream isn't working. Because see, they want us all chasing the next thing. Rising up in the corporate ladder, rising up in the property ladder, getting that new Lamborghini, always chasing. And while that sounds kind of sinister, it's important because that means the economy is moving. There's innovation. Entrepreneurs are taking risks. They're starting new businesses. We're inventing new things. See, the perfect amount of inflation causes all of that, which is really good. See, right now we're dealing with too much inflation, which we'll talk about why that happened. But for example, on the other end of it in 2008, after the great financial crisis, there was a big stock market and real estate crash. And what we had was actually deflation. The economy was contracting. People weren't spending money. They were going bankrupt. Businesses were going out of business. The economy wasn't growing. So things are becoming cheaper and cheaper, which sounds good, but it's actually not. So what did the central bank do? They stimulated the economy by lowering interest rates to almost zero, which really made it attractive for people to go out and buy real estate, go up and buy all those deals that were on sale, for businesses to start construction projects because financing was cheap, to get the economy kickstarted again. So I hope that makes sense on why the central bank is doing what they're doing with interest rates. And now they're trying to do the opposite of what they did in 2008, which was to stimulate the economy. Now they're trying to slow down the economy because we have too much inflation, which basically means employees have gotten too greedy, getting jobs too easily, making too much money. They want to slow it down. And they want you to stop making crazy firm offers on real estate and buying Rolexes and Lambos. So that's what we're seeing right now. And that's why interest rates are at historic 40-year highs. Now, here's the conspiracy, but not really. It's an interesting concept from a lot of economists that aren't really getting a lot of airtime because they probably don't want it to get a lot of airtime. That is, the Fed wants you to think that it's making its interest rate changes based on the CPI reports, which is the inflation reports, on the jobs numbers, on how the economy is doing overall. And while they may consider it, this theory is busting. Yeah, they don't care much about that at all. What they really care about is the price of oil. Now, stay with me, because the Fed's decisions on when to lower or when to increase interest rates correlate strongly with the price of oil, and I can show you with some data. For example, during the lead up to the 2000 dot-com crash in 1997, the price of oil peaked at $27 a barrel and then crashed to $10 a barrel before the Fed started cutting rates to stimulate the economy again, because we had a stock market crash and an economic crisis. Okay, stay with me. In the great financial crisis of 2008, the price of oil in July of 2008 peaked at $147 a barrel. Off the charts high. Now, right before the Lehman Brothers went bankrupt, which really cascaded and started the crazy recession, the price of oil crashed to $33 a barrel. So from $147 to $33 before the Lehman Brothers bankruptcy, before the Fed started cutting interest rates, because of the Lehman Brothers crash and the mortgage crisis, yada, yada, yada. And in more recent times, in the post-pandemic era where the government stimulated the economy by having rates at historic stupid lows, causing the euphoria of the real estate market to boom and everything to boom, the price of oil peaked at $129 right before the Ukraine invasion. That's all I'm saying. That's all I'm saying. Whereas recently it crashed down to the price of $63. Right now, at the time I filmed this video, it's at $80 and highly projected to go much lower in the coming months. And we also know that the Fed and other major countries on the world are just literally months away from cutting interest rates. They've already said that very strongly. Whether it's April, whether it's June, whether it's September, who cares? Rates are getting cut across the world in 2024, that is for sure. Now, when the Fed historically starts cutting rates, that's the sign that the recession has already started. And if oil recently peaked at 129, came down to 63, now it's at 80, the central banks are leading on, they're going to be cutting rates soon. I don't know, it kind of smells like something's coming. Now, what's really going to fry your brain is, do we have a recession because oil crashes and it hits the economy and it hits the real estate market like 2008, et cetera, and kind of cascades through the economy? Or do we have a recession first, which is why oil prices crash? And it's just a coincidence that the Fed starts cutting rates after oil crashes and then we have a recession. Let me know in the comments what you think, but just thinking out loud here, just thinking out loud, judging by how much the American economy and the American military love to patrol and have their hand in every oil market across the globe, no matter where, I'll kind of let you decide which one is which. Now, like I said, this is just an interesting theory, a little bit conspiratorial, but it has some very strong data legs to stand on. So now that we got an idea about central banks and why they do what they do and how interest rates kind of work, let's talk about the effects on real estate and what it means for you. Well, right now it means mortgage payments are going to increase because they've raised rates so high. Now, if you're locked into a mortgage, especially in the United States where you have a true 30-year locked-in mortgage, nothing to worry about. Your payment's not going to change. It doesn't matter what happens with interest rates. You're good to go. If you don't have to sell or move due to personal reasons, it's not really going to affect you at all. Now, in countries like Canada, not so lucky. See, we have 30-year mortgages in Canada as well. However, they come up for renewal every 3 to 5 years, depending what you agreed on. So if you bought your house 3 years ago during the pandemic when interest rates were at 1%, 2%, fantastic. You have a 30-year mortgage at 2%. You don't have to worry. Except coming in 2025 and 2026, a lot of those mortgages are coming up for renewal and you have to renegotiate your rate. And if rates are still as high as they are now, that's going to be a problem. See, to me, being a Canadian real estate investor, now investing solely in the United States, mostly for this reason, we can see how crooked the Canadian financial system really is by not adopting a lending system more like the United States, which is way more fair and makes way more sense. Now, if interest rates stay this high in 2025 and in 2026, when half of the country or more is coming up for renewal, there could be a ton of houses for sale, lots of inventory, which are going to drive down prices and kind of maybe look a bit like 2008 in America. Now, we can speculate and talk about this all the time, and we do on this channel, and it's not expected in Canada especially that we're going to have high rates this high in 2025 and 2026 because the government isn't stupid. They know this, and the vast majority of wealth plans for Canadians are home ownership, just like Americans. People see that as their retirement, as their nest egg, and the government can't go and blow that up, especially in Canada where real estate makes up almost half of our GDP. The construction industry and real estate is an enormous industry in Canada. And with the health of the Canadian economy right now being absolutely terrible, unlike America, yeah, they're going to be cutting those rates and cutting pretty heavy by the sounds of it. So not to worry, however, anything can happen, anything can change, so you got to be on top of the knowledge and subscribe to this channel. Now, normally in hiking cycles like this, when interest rates rise, real estate prices tend to come down and come down a lot. I mean, almost every economist, even the central bank themselves, have admitted, wow, we expected way more of a crash in real estate than what's happened. This isn't really good on our fight for inflation, but it shows the resilience of the economies. And specifically because we don't have the supply and demand metrics that we used to have in the 70s and 80s when a hiking cycle like this absolutely devastated the real estate market. See, at this point, we have too much population growth and not enough houses. Now, there's a number of reasons for this. I'm going to break down some of the top ones so you understand what's going on exactly. And number one, builders aren't building. You have two factors here. Number one, millennials and Gen Zs aren't getting into the trades because we don't want to dirty our hands. Millennials would rather work for companies like Google and Facebook and work in an air-conditioned office or at home. So we have boomers retiring at massive rates from the trades, from bricklayers, framers, tile setters, drywall. All these guys are retiring, and millennials and Gen Zs aren't really signing up to fill the spots. And builders aren't building right now specifically because interest rates are at 40-year highs. The real estate market is pretty slow to dead. So why would they take the risk to start building houses and building projects at super high financing cost right now? They're going to keep that land empty with no shovels in it and just wait for interest rates to come down. Then they'll start building again. Well, that's not really helping our supply issue. Two, millennials are aging, and we're all about the age right now of 31, 32, 35, right at the age where we're having kids, we're in our careers, and now it's time to get out of mom and dad's basement and own our own home. Especially in the West here, where we're told that renting is for losers and you have to own your own home. You need the house with the white picket fence and the golden retriever dog. You got to own your own home. Those are traditional values that millennials are still falling into hugely. So you have this giant generation, one of the biggest generations in a long time, all coming of age, and they want to buy homes right now. They're set in their careers, and we just don't have enough houses to buy. There's not enough houses that are being built. And we continue having massive immigration rates into America, and especially Canada, which isn't helping out the metrics of supply and demand. Now, another reason is that boomers are living longer than normal, and they're more stubborn than any generation. See, they're aging into their 60s and 70s right now and still in good health, and they just want to stay in their bungalow forever. They don't want to downsize, and what they used to do is buy a condo in Fort Myers or Arizona, and they would leave their detached house that would require a ton of work, raking the leaves, fixing the gutters, replacing the furnace, shoveling the driveway. These are things typically that our seniors, retirees, would ditch. But this generation, being so stubborn, they're just staying in their houses, lowering supply even more. Now, when you also add on 30-year locked-in mortgages in America, like I mentioned, where your interest rate doesn't change, now more than ever, people are not moving unless they really, really, really have to. But if you don't have to, why would you sell right now at the peak of interest rates and go buy what? Real estate has jacked up in value over the past 2 or 3 years specifically, and we have super high interest rates. Yeah, you better just stay in your nice little cozy house with your 2% interest rate and ride this out for a couple more years, lowering supply even more. Now, with all that being said, what are the opportunities that we can see right now in this high interest rate environment and this wacky economy? First and foremost, I gotta mention it right away, get into being a landlord. Start owning real estate. Yeah, Matt, sounds easier than said. I'm trying to own a home, but it's too expensive. Well, here's the thing, and here's what's going to be more popular. You don't have to own your own home where you live. A new strategy that we're going to start seeing more, especially if you live in a bigger city, is rent where you live and own where you rent. It doesn't take a rocket scientist to understand that if you hold real estate in a good city that has good fundamentals, good population growth, good jobs, and you hold it for 5 years or more, you're probably going to make a lot of money. This is how most millionaires are made. Even someone not interested in making money or understanding real estate or the economy, people understand that. It's a basic premise. If you hold real estate, you're going to make a lot of money. So if you live in a big city like Chicago, Toronto, New York, San Francisco, where it's too expensive to own a home, but you still want the benefits of owning real estate, rent in those areas in something cheap that you can afford and put your hard-earned money to buy real estate in Tennessee, in Texas, in Florida. For example, in areas that we're focusing on just outside of Houston, Texas, we're buying a 3-bed, 2-bath, detached house with a garage, a nice Pleasantville looking house for $180,000. I mean, that's crazy. If you can't afford to save up money to buy a $180,000 house with a 5% down payment, we got some problems here, and you definitely got to subscribe. I get it. Houses in San Francisco are $1 million for a piece of crap. I get it. So rent there and buy a couple houses in Texas and own those as rental properties, hold them for 5 to 10 years, sell them, double it, and buy 3, 4, 5 more, and keep it rolling. And if you're really savvy, you're going to do what I did, which is start partnering with people and become a real estate investing expert. See, that's how I've bought 150 properties with none of my own money, because I have the skills, the experience, and the knowledge that people are looking for. And they just go, yeah, Matt, I see what you do on YouTube here. You just do it, dude. I'll partner with you. Here's the money. I want to partner. And then I do all the work. I run the properties, I find it, I buy it, I run the contractors, I run the property managers. And in 5 years, we sell the property, we split the profits 50-50. I made a ton of money with putting none of my own money down. Do that 5 times, 10 properties, 20 properties, 150 like I did. That's how you're going to become a self-made multimillionaire. And now finally, you're not caring so much about inflation or how expensive eggs and milk are, because you're a baller and you're financially free. So if you want more of that, subscribe to this channel, and I will see you in the next video.